Good morning, everyone. Firstly, just to introduce myself and the platform very quickly. I'm the CEO and founder of RateSetter. We launched in 2010. We've done about $1.5 billion of lending, gross lending. We lend to consumers, to businesses, to other lenders, and against residential property development loans. So we're very diverse in terms of the lending we do. We have over 300,000 customers. I think the active customers today using RateSetter is over 250,000 people today, either lending or borrowing through RateSetter. So I think that by some distance, that's the largest in the UK. So that's our claim to fame, that we're building actually quite a substantial customer base day by day. Also, just going back, we introduced something called the Provision Fund, which has been talked a little bit about in yesterday and earlier, which has a perfect track record so far. And is managed to what we call a coverage ratio, which I will return to in this presentation. Today, what I want to talk about is something that we call the cost of certainty. And that is basically how the safety that banks promise has a very significant cost, one that is, of course, ultimately borne by us, the customer, and one that peer-to-peer lending is actually exposing and potentially dispensing with. We should look at how peer-to-peer lending is freeing up access to risk and reward, giving people choice and offering real value. So firstly, to banks. Banks' primary purpose, of course, is to guarantee safety for people's money. Given this aim of absolute guarantee, banks are, as you would expect, and as articulated earlier, required to insure against virtually all outcomes. While this is superficially reassuring, insuring against all outcomes, of course, has a cost, what we call the cost of certainty. Peer-to-peer lending, on the other hand, is not seeking to solve for a guarantee. Its primary purpose is to give investors access. By not solving for a guarantee, it is giving investors choice not to pay for the cost of certainty. In order to understand whether peer-to-peer lending and this kind of dispensing of the cost of certainty actually translates into a good deal, one needs to look under the surface and ask, what is the cost of this certainty? In other words, how much do you and I pay for the certainty of outcome? And what is the opportunity cost of doing so? And how much value can you achieve by choosing to give it up? The answer, of course, is this cost fluctuates, driven primarily by how unequivocally safe society, as overseen by the regulator, people like Lord Turner earlier, demands its banks to be. It is worth very briefly looking back at the origins of people putting money in a bank and seeing what they were looking for. Were they looking for return, or were they looking for safety? Well, it turns out they didn't get what they expected. There are many origins of banking, but for the purposes today, let's take the 17th century Britain as a starting place, when the first deposit takers emerged. The frightening thing is that they emerged not by design, but by accident. The story goes, people used to keep their treasure in the Tower of London. One day, Charles I was a bit short, unable to balance his books, raided the Tower of London, took the gold, promised to pay it back, but nonetheless, this kind of behavior spooked the people with the money, and they thought where to put the money. If it's not safe in the Tower of London, where to put it? So they turned to their trusty goldsmiths, the people on the right. Surely it would be safe with them. Goldsmiths were, of course, absolutely delighted to see the money roll in, and they noticed that it stayed there. They thought it was just a temporary measure, but actually the gold stayed there. So they thought, well, how to actually make the storage of this gold profitable? And the answer, of course, was to lend it out. Previously, all lending had been done peer-to-peer, individuals lending their money privately. Now the lending of supposedly safe deposit money had begun. The first banks had begun. The problem was, arguably, that the people putting the money in the bank wanted safety, but actually what they got was risk. Back to today, the answer of how much the cost of certainty is lies with the regulator, arguably on behalf of society, who devises ratios to govern this activity of turning risk into safety. This is a slightly academic kind of presentation, but I was delighted to hear Lord Turner earlier today actually characterize how he'd sat there right at the top fiddling around with ratios. Sure enough, this is exactly what we're saying. But the reality is that this is really just a game of odds, a high-stakes balance of cost-benefit. While banks purport to be completely safe, and society has come to expect them to be so, in reality, we all know that it's really just safety to a margin. While certainty is promised, underlying it, the odds are always changing. The simple answer might seem to be to tighten those ratios and indeed make banks completely and unequivocally safe. Banks may be calibrated to be safe in a 1 in 50-year event, but why not make that 1 in a 100-year event or 1 in a 1,000-year event? You get the point. And again, Lord Turner was interesting today, just saying that you could see the sense that he thought it was a slightly futile exercise just fiddling around with ratios, because you're never going to be right. And I therefore don't really need to explore this debate much further about ever higher capital ratios for banks, because it's been explored by many academics. So if this seems to be a somewhat confusing and indeed futile task, just fiddling around with ratios, the key question is it actually efficient? Is this cost of certainty good value? We'd argue that it isn't, and here's why. This is a very simple diagram that shows that banks are basically too safe for 49 years, implying a cost of certainty that is too expensive, and then not safe enough for that single calamitous year. You can see this by saying that we have 49 dots where the bank is too safe, that is expensive on the customer, and then suddenly it's not safe enough, it crosses the line, breaks the buck, and the whole thing falls apart in terms of societal promise being broken. This, we would argue, is bad for a couple of reasons. Firstly, it's bad economics. It's intuitively inefficient, and therefore bad value, for a system to be wrong one way or the other the whole time, either too safe or not safe enough. We all have to pay for this cost, the cost of certainty. Secondly, it's bad at an emotional level. Humans' natural loss aversion means that we find the single year of failure disproportionately more traumatic than the cumulative comfort of 49 years of success. When banks fail, the impact is chronic. Any loss is intolerable. The effect of 99p being returned is a disaster, even though it's actually only 1p that's been lost. So we would argue it's bad on the national psyche, and of course economic activity suffers. And in this way, banks have put themselves into a straitjacket. They're beholden to a promise that they just can't break. All of this translates into wastage. These inefficiencies, these asymmetries, all cause wastage. The psychological impact of bank failure is so high that inevitably there is an overreaction. Banks are more often than not too safe. This is a massive opportunity cost, a cost of certainty we all overpay for in the form of foregone interest. The opportunity cost of having all of your money in a bank over those 50 years is very significant indeed. Let's say crudely 2% a year for 50 years, that's all your money again, even before compound interest. Put it like that and you realize the cost that you are paying in foregone interest of having your money, all your money in the bank. On top of the wasted economics, you then have the thorny subject of banks breaking their critical promise to society. Inevitably, as it's always been the case, but not in previous centuries, but most recently, the state stands behind those promises, which of course ushers in the troublesome subject of moral hazard, implicit state subsidies, bank bailouts. But that's another story, not for today. But it all seems to end towards this. There is, of course, another way, back to the future, back to the way it was done before the goldsmiths, back to loans being funded directly by investors, back to the reward and the underlying risk going to and resting with the providers of the money. And we argue this is very healthy. We argue that this lack of guarantee is in fact extremely healthy. It is a more symmetrical relationship between risk and reward. By focusing on risk and reward, it is a system optimized for value as opposed to safety at all costs. Freeing investors of the cost of certainty, it is exposing the opportunity cost of foregone interest, and it is giving previously unavailable access to the everyday investor. Structurally, we also think it's very sound. We've heard quite a lot in the last day and a half about the lack of systemic risk in peer-to-peer lending, and I would just add to that. It's a very healthy match. It matches risk capital with risk assets. No transforming underlying risk into purported safety. Moral hazard disappears. The risk of broken promises evaporates. It is optimized for value, not safety at all costs. This can be a more efficient form of financial intermediation because it does away with the often wasteful cost of certainty. Finally, it is specialized. Peer-to-peer lending is simple because it's purely focused on one activity, lending. It can be conducted, therefore, in a simple and transparent manner. While peer-to-peer lending does not seek to offer a guarantee against risk, it has, of course, produced ways of giving investors comfort and a degree of predictability, based primarily on sound credit processes, but also matters of diversification, whether that be by lending of your money to lots of different people, or in the form of a provision fund like happens at RateSetter. This allows investors to manage and quantify risk in a way that I would argue is actually very clear and simple. We've just given an example here of our current setup, which is that effectively on RateSetter and with other platforms that have funds, we are saying that your interest and the receipt of your interest is covered up to a certain amount, is covered up to a margin. I've just put for illustrative purposes that it's 1 times covered. That means it's fully covered. And you can just effectively track the risk of this system by looking at that single number. If it's below 1, then you know that your interest is at risk. If it's above 1, you know there's a little bit of buffer in there. Equally, one thing we've come to realize over time is it's not just the interest cover, which is what we've primarily been focusing on over the last few years, but also there is a quite substantial capital cover, really, with these forms of lending funds, because there is, of course, the interest element before you start losing your capital. And we all know that, going back to humans' loss aversion, that actually the idea that when people realize in peer-to-peer lending that actually their chance statistically of losing money is becoming very remote or very low, then they begin to recognize that actually this is a perfectly sensible thing to have some of your money in. And this is something that we'll be developing as a business to try and make the point that there's the underlying cover of your capital as well as of the interest. So this is one of the key areas that we're saying really on our thing that, going back to the previous slide just briefly, that we hope we've boiled it down to something very simple, and that we are really being asked to judge based on track record and simplicity of numbers, not on some guarantee. That is what we're being asked to be judged on. So just to conclude, nothing changes overnight. Long-established methods and entrenched positions understandably don't disappear overnight. Look back to 17th century Britain again. Charles I may have been decapitated for his transgressions, ushering in a new way of doing things for a while, but sure enough, his son, Charles II, was soon back on the throne. So we all know that things will meander back, and old established assumptions will reassert. Balance is always needed, and there is, of course, a place for the safety of banks as well as the risk and reward of peer-to-peer lending. Track record and trust need to be built up over a period of time before an alternative is accepted. But peer-to-peer lending, as Auxera noted yesterday in their extensive report, is gaining that track record. It is beginning to deliver real value, lower operating costs, no wasteful cost of certainty. And crucially, this valuable is available to all, from the biggest institutions to the normal retail investor. And just as water always flows downhill, so the value of peer-to-peer lending will continue to result in greater flow of funds. I hope in this brief presentation I've shown how banks' guarantee can be their greatest weakness, while peer-to-peer lending's explicit lack of guarantee can be its greatest strength. This is a very healthy development, and we just need to patiently and prudently allow it to come to fruition. We see this as a mega trend at RateSetter, and we're managing our business to be here for the long run. Thank you very much indeed. I'm happy to answer a question if there is one, but otherwise... there is questions.
Okay. Hi, Rhydian. You sort of alluded to it before about the guarantee. So the ultimate guarantee is financial services compensation scheme that the banks use. So if you had a choice, would you rather see the financial services compensation taken away from banks or given to peer-to-peer platforms?
The former.
Good.
Anything else? Any other question I can give a one-word answer to?
Oh, I think that's great.
Okay.
Thanks, Rhydian.
Thank you very much.
Okay.
Thank you, Peter.